25 basis point rate cut. The Federal Reserve lowering its benchmark interest rate by a quarter percentage point to a new range of 3.75% to 4%. The second rate cut this year. Now, this was a split decision. Fed Governor Stephen Miron dissented, preferring to cut rates by a jumbo 50 basis point rate cut. On the flip side, Kansas City Fed President Jeff Schmid wanted to hold rates steady instead of cutting rates. Fed officials announced they will stop shrinking their balance sheet by December 1st. Now, when it comes to the state of the economy, Fed officials said that economic growth is expanding at a moderate pace. That after noting last month that growth had moderated. Now, when it comes to the state of the job market, officials said they haven't seen much change in the state of the job market since they have gotten official data, which they stopped getting as of the month of August because of the government shutdown. They said, quote, job gains have slowed this year and the unemployment rate has edged up, but remained low through August. More recent indicators are consistent with these developments. They also reiterated that downside risks to employment rose in recent months. And officials reiterated in their policy statement that in considering additional adjustments to the target range of the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. Guys?
Jennifer, now we turn to the presser. Jay Powell's going to step up to that mic. You're going to be in the room, Jen. What are you going to be listening for?
Hey there, Josh. So a couple of interesting points to digest here. I think one, I was a little surprised to see Kansas City Fed President Jeff Schmid dissent. I thought that maybe he wouldn't want to rock the boat there, but he had indicated coming into this meeting that he had concerns about inflation and that if the committee were to cut rates again, perhaps that could ignite demand and give firms additional pricing power, offering them the opportunity to pass on higher costs from tariffs to consumers, leading to higher prices. So that was a bit of a surprise. I did expect Miron he pre-announced that he wanted to cut by 50 basis points, so no big surprise there. As for what I want to hear from Powell, I want to see how he frames policy action for December. I don't think that he's going to be committal. I think he's going to say we need to be data dependent. We need to continue to take things meeting by meeting. Of course, they're still waiting to get official data as they wait the government to reopen. However, what I will be looking for in terms of clues for December is how he characterizes the state of the job market. They indicated in the policy statement that things haven't really changed in terms of the state of the job market. I'd like to get some more color there because they also said in the statement that downside risks had deteriorated. So looking at the anecdotal evidence and some of the unofficial private data numbers like ADP, are they more concerned now about the job market? And if they are, then that to me would point to another rate cut on the table for December.
You got your cut, but then Jay Powell talking about the December cut says, hey, no sure thing. Far from it, I think is what he said. You were listening to that. What did you make of that as an investor?
We like the logic that I call 2-3-4. What is 2-3-4? If we get to inflation of 2%, then Fed funds should be 3 and the 10-year Treasury should be 4. So we can call this the last of the easy Fed cuts because inflation's not at 2, it's at 3. So therefore, Fed funds in a neutral spot would be 4 right now. Hence, this is the last of the easy cuts. And I think that's a lot of what Chair Powell said. The next one's not going to be easy. We're going to have to start to make some progress to 2% to cut meaningfully further, and that's important. But the other takeaway of 2-3-4 is what's already at 4. The 10-year is already at 4. No surprise that it sold off just a little bit. You had 25 bips off Fed funds, and the 10-year yield went up 10 basis points this week because we're not all the way down to 2% inflation.
Well, let me ask you, if you were spinning ahead in December, and let's say you did get a pause, I'm curious how you think the stock market would react to that.
So I don't think that that's much of a headwind for the equity markets, nor would I suggest that a cut is much of a tailwind because the long end is likely to be stable. Multiples for at least large cap stocks are more driven by the longer end of the curve, which is probably going to be range bound for the logic of 2, 3, 4. Now, you can still get a little bit of a benefit to small cap stocks in emerging markets, which have more debts at shorter term maturities. So there you can see a little bit sensitivity to whether the Fed cuts or doesn't cut.
What about those, there were folks on this very show, Samin, who weren't so sure they should be cutting. Their point being GDP is hanging in there, unemployment's low, the stock market's working, not typically an environment you'd be cutting into.
No, that's exactly right.
Yeah.
In other words, we are probably around neutral right now if inflation is at 3%. And if the risks of the employment market and inflation are roughly balanced, you should stay here until inflation gets down. Now, one of the important things, if you were listening to Powell's comments, was he's actually in the camp that we're closer to 2 than people think. He suggested that their approximation in the absence of all the data we have is actually more like 2.8%. And they're still very convinced, we heard this years ago from the post-COVID context, but very much in the context that any tariff impact would be transitory.
I want to get you this. We talked earnings, we talked Fed. We also got to talk trade because Trump and Xi meet this week. Is the first, face-to-face meeting in a while for those two. It does seem like tensions are at least de-escalating. How, as investors, should I think about that?
Look, it's a darn good thing that it's de-escalating. But if we think about the impacts of tariffs, let's hope that Chair Powell is right, that the impact to inflation is transitory. Let's also hope that the impact to GDP is transitory. You have to go back to your first semester of economics. It's just the supply and demand diagram. If prices go, if a tariff would simply be roughly half borne by consumers and half by producers, because demand is elastic. Demand will go down a little bit, and then prices will go kind of part way down. Simple stuff. But that extra little piece is important. Demand would go down slightly. In other words, there would be a small nick of GDP if tariffs stay high. So, for those of us who are not only generally, free traders, again, nothing's really free. We know in the world there's lots of things going on, but the markets will like lower tariffs, but in higher.
Solid data, or potentially the lack thereof, will play a crucial role in additional Fed decisions. And how much patience does the Fed have from here? Well, joining us now, we have former St. Louis Fed President Jim Bullard, who currently serves as the Dean of the Mitch Daniels School of Business at Purdue University. Jim, great to see you as always. So we're waiting now, Jim, for Jay Powell, of course, to step up to the mic, answer those reporter questions. But we have the decision, Jim. Curious, high level, what you make of it, what you made of the cut. And do you think, Jim, another cut is coming in December? What are the variables that depends on?
This one was widely anticipated, so it came through as expected. They ended the balance sheet runoff, which was also widely anticipated in financial markets. They won't actually end, it doesn't sound like, till December, but they certainly set it in train. So I think this is widely anticipated. Now, for December, I think it's a little more open decision. I think the chair will emphasize that they'll need to see data that support going ahead in December before they'll commit to that. And then for 2026, the committee has not said very much about 2026, and this is the first time that January will really come into play here. And I don't think that they intend to go to make a move in January. I think that they would want to spread any future moves out at a slower pace. So we'll see. Might be a little too early to get into that, but we'll see if that comes out in the press conference here.
Jim, we've been talking all day and for the previous days about the lack of data coming out from the government. As somebody who served on the FOMC, talk to us a little bit about what you might think is going on inside the room as they're trying to make this decision without that data. Yes, there are private reports. Yes, CPI came out, but they don't have the official jobs data. So how do you think that process is now working?
They love the non-farm payrolls report inside the Beltway, and that's the favorite piece of data for the committee. So they are missing that. I would say you can look at something like the Kansas City Fed's Labor Market Conditions Index, and you can look at it with or without the non-farm payrolls numbers. And they've done that, actually. So if you click on that, you'll find that the labor market looks like it's about an equilibrium. And that's consistent with a relatively low unemployment rate. So I think the main issue for the committee here is that the economy seems to be reaccelerating. And except for the payrolls number, which we don't have, labor market seems okay, and you still got pretty high inflation. So I think that's going to cause the committee to bring rate cuts to a halt at the end of the year here.
You know, Jim, in the absence of government data, though, you do see this clockwork of headlines here of companies laying off folks, Jim. I mean, GM, Amazon, Target, Molson Coors, Applied Materials. I know it's anecdotal to some extent, Jim, but I'm curious, you see those headlines. What do you make of that? And what do you think the Fed makes of it?
Yeah, I think there's AI feeding frenzy for the large caps, the so-called, the major cloud providers for AI, and they want to show that they're not behind, and they want to argue that they're using AI to eliminate jobs. That's helping them with their stock price, but not at all clear to me that that's really what's going on. I think they're probably reallocating toward AI so as not to fall behind in the race with the other mega cap companies. Other companies have, I think, different issues in different places. Certainly, General Motors, completely different type of business. Retail, also non-Amazon retail, completely different sort of business.
Jim, I want to come back to the dynamics on the Federal Open Market Committee, because as we've been talking about, we had one dissent in the form of Schmid, who said he didn't want to cut at all, and then Stephen Myron saying he wanted to cut by a half of a percentage point. What does this tell us about the dynamics within the committee, especially given that Jay Powell is coming to the end of his tenure?
Yeah, I'm sure the chair probably doesn't mind getting a dissent on both sides that kind of averages out. And so that has happened sometimes in the past. I do think there's a contingent on the committee that is concerned that inflation is still running at 3% and that it has not come down very much in the last 18 months, really. And they want to see more progress on that. There is a good story for that the tariff effects are temporary and that the inflation will continue to move down next year. But I'm sure they'd like to see some evidence of that before committing to further rate cuts. So I think the way to think about these cuts this fall is that this is a recalibration of the setting of monetary policy, and an appropriate one, but one that still leaves the setting a little bit restrictive so that you can still get downward pressure on inflation and eventually get back to 2%.
Jim, I got to ask you, Powell's term, as we know, coming to an end in May. So now the question becomes, okay, who is the next, Jim, most powerful central banker on the planet? Bessent, our Treasury Secretary, he says five names, Jim, in no particular order. Got Hassett, Waller, Warsh, got Rick Rieder, Michelle Bowman. I'm interested, Jim, how you think the Trump administration is screening for this. What qualities do you think they're looking for?
I thought the Treasury Secretary put together a pretty good process. I was part of that earlier. And I think these are all very respectable candidates. I know at least 4 out of the 5 very well. Rick Rieder I don't know as well, but so I think you've got a talented group. Like any big job, they would bring different qualities to the table, and they would probably have to, adjust to the position in different ways. And so I think that's a judgment that the Treasury Secretary and his team will have to make, and ultimately the president will have to make about who they want in this spot.
Do you think, Jim, that there's still a risk of the person being seen as a proxy for the administration? And if that's the case, is there then sort of an issue with how those decisions will be viewed by the market?
Yeah, I mean, if the market starts to worry that interest rates will be kept unnaturally low and that'll feed into inflation, they'll price that right in right away. And so you would get an inflation risk premium. So I think you need to, for anybody that would take the job, you need to commit to the 2% inflation target and make sure that you're going to take steps to maintain that level of inflation. Otherwise, markets will just price it in before you even get in the job.
Jim, I always like your take on this. We're waiting for the presser. We're waiting for Powell to step up there. Reporters are gonna ask a lot of questions, Jim. Let's say I make you a reporter, Jim. You're now a business journalist. You have the chance to ask Powell a question or two. What would be top of mind for you?
I think the questions here might be about the balance sheet. They're stopping the runoff. The Treasury Secretary seems to have said that the large balance sheet is maybe not something that he wants. So are there plans for the committee to get the balance sheet down to a smaller size? I think there are ways to do that, but the current committee seems to not be oriented in that direction. That seems to be different from what the Treasury Secretary is looking for.
Well, for more on Powell's remarks, we're welcoming back now J.P. Morgan Asset Management's Mira Pandit, along with Colin Martin from Schwab Center for Financial Research. Welcome back to you both. Mira, I'll start with you. You were listening carefully to Jay Powell field all those reporter questions. What were your big takeaways?
If we think about these press conferences, they're often used as a forward guidance tool, and Chair Powell hit that right on the head right in the beginning, emphasizing that December rate cut is not a foregone conclusion. Now, what's interesting as we look at some of the market pricing is if you look out to next year, we've been saying, look, the market expects the interest rate environment to get back to neutral. Is the Fed quite there? But actually, you might be in a situation where both the market and the Fed think we're going to get to neutral, but they have very different conceptions of what neutral is. With the market anticipating that neutral is around 3%, but the Fed actually thinking maybe it's closer to 3.5%. And what's interesting is that Chair Powell has characterized the cuts as risk management, which he said before. And what that implies is maybe we're not that far from where we need to be. And inflation, if you strip out some of those tariff effects, PCE might actually be on a core basis closer to 2.2 or 2.3%. So you put all of that together, and while there's a lot of dissent and discussion within the Fed, it actually seems like they're a lot closer to the end game than maybe markets appreciated.
Colin, you were listening as well. Your big takeaways.
Yeah, I think a big thing about the Powell comment about a December cut not being a foregone conclusion, I think that actually even minimizes it. He then said it again and said it's far from a foregone conclusion. So that's kind of in line with our thinking. And he laid out his thoughts there about the cooling market, the cooling labor market, where it's just that. It's cooling. It's not falling off a cliff. We're seeing this gradual slowdown. And there was a key point he made as well when he talked about what we're seeing with the labor market, but then also what we're seeing with the growth outlook right now. And he questioned if the growth we're seeing is real. You know, we saw that those really positive revisions as we got the second and third revision to GDP that showed that the economy's growing, the consumer's spending. So I think his thinking, and this might just be Powell, maybe it's not indicative of the whole committee, but should we be focusing more on that than the slowdown in hiring and the unemployment rate at 4.3%. So I think that's what we're focusing on. As we talked about earlier, things are okay right now. We don't think the economy has an interest rate problem. And I'll build on Mira's points. What is the neutral rate? If the unemployment rate's at 4.3% right now and inflation's near 3%, we're probably not that far off from neutral. And neutral is probably not at that 3% or less level that the markets are pricing in.
Mira, did you hear anything today in the presser that caused you to change how you think about advising clients about where to put money to work, where the opportunities are, what to avoid?
I think that we have to consider the market fundamentals as opposed to some of the assessment of the Committee of the Economy. I think we're all looking at the same data and looking at things pretty similarly. There's no risk-free path here. There's a good case to stay where we are in terms of rates, good case to cut. But when we think about what's going on in the markets themselves, we certainly want to be mindful that there is this everything rally going on, but we don't need to rally behind everything. We need to make sure we're still geared towards quality. We need to make sure we're still managing concentration risk and some of the valuation risks within portfolios, and maybe AI proofing our portfolios to some extent. We've seen the AI trade move from just concentrated innovators in AI to some of the AI enablers in industrials and utilities. And the next phase is the AI adopters. Let's see how strong that adoption does come through, and in particular that paid adoption. But let's also think about trades outside of the AI complex. Things like financials. We go back to earnings season and we see that financials are going to contribute about 44% of the overall growth in earnings of the S&P 500. So that's where you're getting your earnings growth outside of tech, unrelated to AI. Think about making sure you have some balance in your portfolio across different areas that could continue to have some legs.
It was interesting because the AI trade and trend came up, right? And he was asked about that. And it was interesting how Powell talked about it's different, he said, than the dot-com era. He emphasized that. He said how these companies have earnings. It does come, though, as there have been some high-profile investors who have thrown some caution flags. Some have even said they hear echoes of the dot-com.
Well, as it relates to monetary policy specifically, I think that Chair Powell is certainly right in the fact that these are not really interest rate sensitive deals, because a lot of that CapEx that's being spent is not because rates are low and companies are levering up. It's that they're spending the cash that they have. They are generating revenue to fuel future investment. And some of it is really coming from the idea that these stocks continue to go up. So you think about the equity component that's really funding a lot of this CapEx. So I do agree with Powell that the interest rate component of all of this is not as relevant to some of this AI spending and CapEx, which really brings us back to what we were talking about earlier and an hour ago in terms of the fact that a lot of the challenges, whether it's the potential bubble within the equity market or within the economy, if it's any weakness in the jobs market or the housing market, is not actually all that interest rate sensitive.
On the lack of government data, right, Colin, that came up as well. And Powell gave an answer saying, listen, basically we still have a picture of what is going on in the economy, in the labor market. How much of a challenge has it proven to you in your job? I ask only because, Colin, some investors have said, listen, I have plenty of lines of sight still. On the economy, I got bank earnings, I got credit card data. Where are you trying to fill in the gaps?
Yeah, we're using some of those alternative data metrics. We know that ADP is going to start releasing that weekly employment release. We have a lot of surveys, whether it's from the district banks themselves. I think Powell said they're kind of leaning on them. We get ISM surveys, consumer confidence. So we can fill in the gaps. But it's really difficult to truly fill in the gap without the CPI, without the jobs data. We're big fans of that government data. It's comprehensive, it's available to everyone. And a risk we see in the shutdown, but even if there's a lack of trust with government data going forward, if we get these private pockets of data, does it go to the highest bidder? Who has access to that? So for now, it's okay. As time goes on, it's going to get a lot more difficult because the payrolls number, the unemployment rate, those really matter. And without them, it's tough to get a complete picture of what's going on.
All right, well, you guys have both given us a great picture today. Colin, Mira, thank you both so much. Appreciate it.